Market structure is probably the most important concept in all of trading, and it's also the one almost everybody skips. They jump straight to strategies, indicators, entry signals, all the exciting stuff, and then they wonder why nothing works. So in this video, I'm going to fix that. I'm going to teach you market structure the way I wish someone had taught me. Here's the thing nobody tells you. Every strategy you've ever learned, supply and demand, smart money, ICT, all of it, every single one assumes you can already read the market, that you know what it's doing right now and where it's likely going next. That ability is market structure. It's the foundation. And if your foundation is weak, everything you build on top of it collapses. This is a complete course, not a quick tip video. By the end, you'll have a simple framework you can run every single time you open a chart. You won't be guessing anymore. You'll be reading. So stick with me the whole way and save this video because you'll want to come back to it. Here's our roadmap. Candles as battle reports. Volume as your truth detector. The 4 states every market is always in. The green light that says a trend continues. The power shift that says control just changed hands. Why your stop loss keeps getting hunted. And finally, a 5-step framework that ties it all together. 2 things to keep in the back of your mind. That 5-step framework at the end, and the answer to why the market always seems to hit your stop right before it goes your way. We'll get to both. Let's start. Let's start with something you look at every day, but probably never think about deeply enough. A single candle. Most people see green and think bullish, red and think bearish. But that's like reading a war report and only looking at the color of the ink. Every candle on your chart is a battlefield report. It tells you who attacked, who defended, and who ran out of ammo. A long green body isn't just bullish. It means the bulls dominated from open to close, pushing price up with almost no resistance. The bears didn't even show up. A long red body is the opposite. The bears forced price down without mercy. Now here's where it gets interesting. A long upper wick means the bulls tried to push price up. They attacked, but they got smacked right back down. A failed attack. A long lower wick means the bears tried to drive price down, but someone ate all their selling. The other side stepped in and said, "No, we're buying everything you throw at us." And a doji, a tiny body with wicks on both sides. That's a stalemate. Neither side could win. They fought to a draw. So here's the mindset shift. When you look at a chart, stop seeing green and red. Start seeing who's attacking, who's defending, and who's running out of energy. Because that's what tells you what happens next. Lock it in. Every candle is a battle report. Read the fight, not the color. That's module 1. Now let's add the one thing that tells you whether that fight was actually real. Real quick before we go deeper. And this connects to exactly what we're learning. I want to tell you about Alertsify. Because reading the market is a skill that takes time to build. And while you're building it, Alertsify lets you learn from the people who've already mastered it. Here's why it's different. Every trade on the platform is verified straight from the broker, not screenshots someone could fake. Real trades from real professional traders, pulled directly from their broker account. And the second a pro takes a trade, Alertsify copies it into your account automatically, in under a second. You watch how they read the market in real time, while it's happening. The Pro plan is $1,997. Not pocket change, I know. But most people make that back within the first month just copying the pros. So while you're learning to read charts like we're doing right now, you can be earning at the same time. Links in the description. Now let's get back to it. This next part is the truth detector. You can now read who's winning a candle. But here's the critical piece almost everyone misses. Price tells you who's winning, but volume tells you if they're actually strong. This is Wyckoff's principle of effort versus result, and it's one of the most powerful tools you'll ever learn. Volume is your truth detector. Here's how to read it. High volume with a long candle body. That's real money pushing the market. Trust it. But low volume with a long candle body, be careful. Price is sliding through empty space with no conviction behind it. That's a trap, and it won't last. Now this one is gold. High volume, but a short candle body. That's a warning sign. Someone is putting in massive effort, but price isn't moving. That means the other side is absorbing everything thrown at them, eating every order. And when absorption happens, a reversal is often close. Remember this line. When effort doesn't produce a result, someone is being betrayed. And that's exactly when structure is about to change. One quick note. This works best on markets with real volume data, futures, stocks, major crypto. If you trade spot forex, your platform shows tick volume, not real traded volume. Still useful as a rough guide. Just don't treat it as gospel. And don't act on any of these volume clues alone yet. On their own, they're just clues. They become powerful when we combine them with what's coming next. Lock it in. Price shows who's winning. Volume shows if it's real. When effort doesn't match the result, change is coming. Module 2 done. Now let's zoom out to the big picture. Now the bigger picture. Before you ever think about a trade, before entries, before stops, before anything, there's one question you must answer. What state is the market in? There are only 4, and if you get this wrong, nothing else matters. State 1. Uptrend. Bulls in control. Mechanically, the bulls push price up and break the previous high, a new higher high. The bears counterattack, but the bulls defend and create a higher low. Higher high, higher low, over and over. The bulls keep expanding their territory, and the volume confirms it. High on the pushes up, low on the pullbacks. That tells you the bears are losing steam. There's one line that matters more than anything in an uptrend: the higher low. It's the bull's lifeline. As long as they defend it, they're in control. Lose it, and they lose the war. Your rule in an uptrend is simple. Only look for buys. Trade with the army that's winning. State 2. Downtrend. The mirror image. Bears break the previous low for a new lower low. Bulls try to recover but get pushed back down, making a lower high. Volume is high on the sell waves, low on the recovery attempts. The key line here is the lower high. That's the ceiling. As long as the bears hold it, they're in control. Your rule: only look for sells. State 3. Ranging. I call this the ceasefire. Most traders see a range and think boring, nothing happening. That's a dangerous assumption. Ranging often means smart money is quietly doing their work. Price bounces between 2 clear boundaries, support and resistance, and volume spikes at those boundaries, because real money is active there. Here's the deeper layer. Heavy volume at support with a strong bounce after. That's accumulation. Someone is buying everything. Heavy volume at resistance with a hard rejection. That's distribution. Someone is selling into every push. Your rule in a range: let the higher time frame trend tell you which boundary to trade. Bullish, bigger picture. Buy support. Bearish. Sell resistance. Not sure? Wait for the breakout with volume. State 4. Choppy. This is no man's land. Stay out. Choppy markets are chaos. Overlapping candles. Back-to-back dojis. Long wicks both ways. Every breakout reverses in a candle or two. Fake outs everywhere. Volume is dried up or random. Neither side is committed. You're not fighting an army. You're fighting shadows. Your odds are a coin flip. Here's how to tell ranging from choppy, because it's critical. In a range, the boundaries are clear and tested multiple times. Swings are clean. Volume follows patterns at the edges. In choppy, boundaries are blurry and keep breaking. Candles overlap with no direction. Volume is random. Range, you can work with it. Choppy, get out. And if you're not sure which one it is, treat it as choppy. When in doubt, stay out. The market always gives another opportunity. Your capital won't. Lock it in. 4 states: uptrend, downtrend, ranging, choppy. Identify the state before anything else. And if it's choppy, walk away. Module 3 done. Now the most important part of this entire video: how to know when the state is changing. You know the 4 states. Now the critical question: how do you know when one is changing? This is where 90% of traders make fatal mistakes, so slow down. This section is the most important part of the whole video. We start with BOS, break of structure. I call it the green light. It simply means the side in control keeps expanding their territory. In an uptrend, a BOS happens when price closes above the previous swing high, not the all-time high, the most recent swing high. Each time the candle body closes beyond the last swing point, that's a fresh green light confirming the trend is alive. In a downtrend, it's the mirror. Price closes below the previous swing low. But there are 2 conditions for a valid BOS. First, the candle body must close beyond the level. Not just a wick poking through and pulling back. A wick through is a trap. Only a body close confirms the territory. Second, volume should increase on the breakout candle. That tells you real money is participating, not just noise. Lock it in. A BOS, the green light, means the trend continues. Your move is to look for entries with the trend on the next pullback. Module 4 done. Now the flip side, when control actually changes hands. Now, CHOCH, change of character. I call it the power shift. This is where control transfers from one side to the other. It means the side that was in control just lost their most critical defense line. Here's a bearish power shift, an uptrend dying, in 3 steps. First, the bulls fail to push to a new higher high. Their attack is exhausted. Second, the bears counterattack and close below the most recent higher low with increased volume. Third, the bull's lifeline is broken. That's a power transfer. The bullish version is the mirror. Bears fail to make a new lower low. Then bulls break above the most recent lower high with volume. Now watch out for a sneakier version. Sometimes price makes a new higher high and you think the trend's continuing, but then it immediately gets slammed back down and breaks the previous higher low. That new high was a liquidity grab. Smart money used the breakout to sell into all the FOMO, then crashed it. So don't assume a new high means you're safe. Watch what happens right after. If structure breaks on the way down, that's the most dangerous power shift, because it trapped everyone first. And here's the part that will save you a lot of money. A CHOCH does not mean immediately trade the reversal. Let me say that again. A power shift does not mean enter in the opposite direction. It means stop trading the old direction. That's it. The transition zone right after a CHOCH is the most dangerous place on any chart. Here's what actually happens after a power shift. The market almost never jumps straight into a new trend. There's usually a consolidation period. That's where smart money builds their new position. The new trend is only confirmed when you see the first BOS, the first green light, in the new direction. So remember, CHOCH means stop your old trades. The first green light after it means go for the new direction. Now the number one mistake with CHOCH: confusing noise with a real change. Inside every move there are tiny highs and lows. Breaking a minor internal one is just noise, not a reversal. Here's the practical test. A major swing point is one that's clearly visible when you zoom out or switch to a higher time frame. If you have to squint to see it, it's noise. The golden rule: a valid power shift only happens when price breaks the major swing point that created the most recent green light. Break a minor low, ignore it. Break the major one, that's real. And this overrides everything. Always check the higher time frame first. A power shift on the 5-minute means nothing if the 1 hour shows a strong uptrend. Think of it like an army. The daily chart is the general's strategy. The 1 hour is the battlefield commander's plan. The 15-minute is one soldier's view. A soldier can win a skirmish, but the general's strategy decides the war. Use at least 2 time frames. Read the higher one first, and never trade a lower time frame signal that fights the higher time frame. Lock it in. A CHOCH, the power shift, means stop trading the old direction. Wait for the first green light to confirm the new one, and always respect the higher time frame. Module 5 done. Now, remember I promised to explain why your stop loss keeps getting hit? Here it comes. Have you ever noticed the market seems to hunt your stop loss? It targets your exact level, takes you out, and then moves exactly the direction you wanted. That's not bad luck. That's by design. And once you understand it, you'll stop being the victim of it. Here's why. Imagine a hedge fund wants to buy $100 million of an asset. They can't just hit buy. If they did, price would rocket up before they finished filling their order. They'd ruin their own entry. To buy at a good price, they need sellers, a lot of them. But who sells in an uptrend? Nobody wants to. So price gets pushed below a key support level, just far enough to trigger thousands of stop losses. And here's the key insight most people never realize. Every buy stop loss is a sell order. So those thousands of triggered stops create a massive wave of selling. And that selling is exactly the liquidity the big player needs to fill their buy at a discount. You weren't unlucky. You were the fuel. Now look at your chart differently. It's a map with pools of liquidity at predictable spots. Above old highs, especially equal highs tested multiple times, sits buy-side liquidity. Below old lows, especially equal lows, sits sell-side liquidity. Smart money doesn't trade breakouts. They exploit breakout traders. This is exactly how bull traps and bear traps work. A bull trap: price breaks above resistance. FOMO traders pile in, smart money sells into all that buying, then price reverses and triggers everyone's stops. An avalanche down. A bear trap is the mirror. Price breaks support, panic selling kicks in, smart money buys every discounted order, then price rockets up in a short squeeze. So how do you protect yourself? You learn to tell a sweep from a real green light. A sweep a trap, has a long wick poking through the level, but the candle body closes back inside the structure. Volume spikes on that candle, then drops, and the next candle reverses. That's smart money collecting liquidity. A real BOS has the body close outside the structure, volume that stays elevated across multiple candles, and the next candles continue in the breakout direction. Here's the rule that will save your account. Always wait for the candle to close. Never enter while a candle is still forming. Wick through equals trap. Body close through equals confirmation. Most breakouts fail, which is why entering before the candle closes is one of the riskiest mistakes you can make. Lock it in. A wick through a level is a trap. A body close through is real. Always wait for the candle to close. That's the loop closed. Now you know why your stops get hunted and how to stop being the prey. Module 6 done. Let's tie it all together. This video didn't teach you when to enter a trade. It taught you something far more important, how to read the market. And that's the most fundamental skill you'll ever build. So here's the 5-step framework I promised you at the start. Run this every single time you open a chart. Step 1. Check the higher time frame. What does the daily or 4-hour say? That sets your direction. The general strategy comes first. Step 2. Identify the state on your trading time frame. Trending, ranging, or choppy. If it's choppy, close the chart and walk away. Step 3. Determine who's in control. Are you seeing a green light confirming the trend, or has a power shift happened and control is changing? Step 4. Check for traps. Is this a real breakout or a liquidity sweep? Wait for the candle to close. Check the volume. And step 5. If and only if all 4 steps check out, then you move to finding your entry zone. That's exactly what the next video covers. Most traders learn entries before they learn to read the market. They apply the right technique in the wrong context and wonder why they keep losing. Now you won't. Let's stack everything. Candles are battle reports. Volume is your truth detector. Know the 4 states and walk away from choppy. A green light means the trend continues. A power shift means control is changing. So you stop, you don't reverse. A wick through is a trap. A body close is real. And you run the 5 steps every single time. That's how you read the market. Not guess. Not hope. Read. So here's what I want you to do right now. Open any chart you're watching and run the 5 steps. What does the higher time frame say? What state is it in? Who's in control? Any traps? Drop your analysis in the comments. I'll review them, and make sure you're subscribed, because the next video builds on everything here, the exact buy and sell zones, and the entry method that changed everything for me. Save this video, you'll want to come back to it. I'll see you there.